Joining me for this special holiday edition of Chart This is Gary Wagner. Gary, thanks so much for being with us.
My pleasure as always.
Gary, let's start off by looking at that strong data we saw come out of the U.S. last week. Unemployment rate now at a 5-year low there. Obviously, gold struggling to find its place amidst this positive data we're seeing. How do you see things?
Well, I thought it was really interesting in terms of the play that we saw last week. Of course, the jobs report was anticipated to come in at around, I believe, 180,000 names, came in at 203, which is really bullish for the economy. It shows that the economy is starting to really gather some steam. And we saw gold actually trade off about $10 initially after we saw that report come out and go public. However, within an hour or so, we saw it not only recover, but move to about $10 positive to trade over the weekend and actually close in positive territory on Friday. To me, that was really a pretty strong signal saying that they're attempting to find some support in this current area.
Gary, last week I know you were looking for gold to hold 1275. What are some new targets you're now looking at?
Yeah, I mean, since then we've seen the market slip dramatically. It's hit an intraday low of, I believe, 1211. But the key has really been, on a short-term basis, a triple top that we've identified at roughly 1255. So as the market came down and made a series of lows, each time it attempted a rally, it tended to stall at 1255 and then move lower. On this last rally of last week, I believe we had a high of 51. So slightly lower high, but we also had a lower low because that's when we had the 1212. I still believe that there is an opportunity to retest the 1181. We're not that far from there. However, at the same time, I am seeing some signs of a potential bottom in the market and possibly even a double bottom matching the 1181.
And once that bottom is reached, Gary, could we then again start looking at things more bullishly?
Well, absolutely. In terms of Elliot wave, which is one of the techniques that I use, we are just finishing a fifth wave of a long move down, and that move down is really from 1800. Once that has concluded, according to Elliott wave theory, we're going to see a series of rallies, an ABC, which will basically be a strong wave up, a small correction, and another strong wave up. So I think that whether we find our bottom here, 1181, at the point that we have identified a bottom, we should be able to see a rally which moves it off of these lows by about $200 to $300.
Gary, now let's look at that outlook for gold in 2014. How do you see the metal set up as we're about to enter the new year?
The market is extremely oversold. The predominant mentality of traders out there has been bearish on gold. Even a lot of the staunch bulls have gone bearish on the market. And typically you'll get bottoms in the market when it's really weighted in an extreme way to one side or the other. So if everybody out there is extremely bearish, that tends to be the beginnings of any kind of a bull run. We haven't gotten any technical confirmation as of yet that we are out of this bear count or a bear progression to the downside. But we are hitting numbers that are numbers we should absolutely look at because they are potential numbers for pivot points or key reversals.
Excellent, Gary. Now let's get to your insert. What have you brought us today?
Well, I'm going to be looking at two different pattern types. One is going to be a model of a continuation of the fifth wave down and where it might terminate. The other one is basically called a truncated fifth wave, or what we call a flat, in which the two lows are equal and then it moves off of the lows. So one is a scenario or a model in which we could see a little bit lower pricing, and the other one is a potential that what we're looking at now is really a setup for a nice run to the upside.
All right, Gary, let's get to it.
It is hard to believe that another year has come and quickly will be gone as we go into the conclusion of 2013. There's no doubt 2013 was a very, very difficult year in terms of gold pricing itself. When we take a look at 2013 to 2014 that we're quickly approaching, we can see that the underlying characteristic, without a question of a doubt, has been a severe, dramatic drop in price. Market dropped roughly from, call it 1650, that's right in here, coming off of this triple top at 1800 and pretty much had a parabolic fall down. Very, very similar to the parabolic rises that we saw that were really the underlying characteristics of 2010 and 2011. We really had the opposite effect. Now, we had one major rally, of course, in 2013, and that is after the market came down from 1800, it makes its low at 1181, and 1181 we go up to about 1435. That really is the most significant rally that we saw. Other than that, we pretty much saw the market trading lower, losing double digits in terms of percentages. And on today's chart, I want to go into a little bit of a review, but more importantly, our forecast for 2014. We have been under so much dramatic pressure in the precious metals markets that I do believe that we will see the market bottom out and unfold in one of two ways. And I'm basing this on our Elliot wave count, our current Elliot wave count, which is a bear count in which we are in the final fifth impulse wave. Of course, an impulse wave and a bear count is a move to the downside. And really, here's what we're looking at. This is the basic setup for what I believe. Tremendous rally. This rally itself was of incredible precedence. 1, 2, a very long third, fourth, and a fifth wave. This was our impulse phase as the market went to new contract and record highs above 1900. From there, we went into a basic A, B, C retracement. And during this corrective retracement period, we believed that we had concluded our sell-off. The market was trading at roughly 1535. This was a long-standing support line. Let's go ahead and kind of put that line in here. And basically, looking back at it, what happened was this, the best way to explain the market activity. Market goes back into an impulse phase, but it really gets knocked solid when it hits this resistance at 1800. The impulse phase fails, and we, in essence, go into our bear market count. Wave 1, wave 2, long wave 3 down, wave 4, and our current wave 5. Now, that being said, when we take a look at the market in this way, I personally believe that we have one of two possibilities in the way that this market's going to conclude. First of all, in some manner of speaking, we will conclude this fifth wave. And when we conclude this fifth wave, we will basically go into an ABC correction. But an ABC correction, of course, in a bear count is to the upside. So you would get something like this. 1, 2, 3, 4, 5, wherever it terminates. Then you're going to get an A, a B, and then a C. So your corrective period in a bear count is going to be a bullish rally composed of 3 waves, A and C moving to the upside against the current trend, and the current trend has been down, and your counter wave right here, which is going to be your B wave. I absolutely see that unfolding in 2014. The real question is how we will terminate our basic fifth wave. And there's 2 models that I want to take a look at on today's show. The first standard way we would look at this market unfolding is typically when you have your 5 impulse waves, 1, 2, 3, 4, and 5. Wave 5 is typically, in terms of price move and duration, approximately the same as 1. So as you can see, I've created a single scalable line in which I'm looking at the range from the beginning of 1 to the conclusion of 1, and all I'm going to do is carry it really to the top of C, which is here, or the beginning. And when I do that, what we're going to do is actually have a forecast in terms of where we think this market could go. In a standard zigzag, typically what you're going to get is wave 5 is definitely going to fall below the low of wave 3. We have the low of wave 3, that being 1181. And if we look at this particular line and look at where it concludes definitely above the conclusion or the low that we got in 3 and falls somewhere around 1100. So that if our model our current Elliott wave model unfolds in a standard manner, we would have our wave 3, our wave 4, and then a lower low on wave 5. And I would look for 1100 to be about the base or the absolute low, the washout point in which we would see the market begin to rally. From there, you would get an A, a B, and a C counter wave or corrective phase, and then it would return to a impulse phase. And an impulse phase, of course, once again, would be just like we saw here, 1, 2, 3, 4, and 5. However, there is another possibility, another model that is simply called a truncated fifth wave or a flat. Because of time permitting, I will have that available on our website, thegoldforecast.com, and that will cover a bear market truncation. To get to the bonus content, simply go to our website, thegoldforecast.com. We have been working to completely redesign it and add a lot of features that we'll talk about in the upcoming shows in 2014. But if you scroll to the bottom under commentary, you see one of the menu options as after the show. If you click that, that will take you to the Kitco bonus content area, and we will place part 2 of our 2014 outlook there. This has been Gary Wagner for Chart This, and as always, I want to wish you good trading.
Excellent, Gary. Thank you so much.
My pleasure.
And happy holidays to you, Gary, and to all our viewers. We hope you enjoy our Outlook series. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.